Let's embark on a journey to master tax strategies with Kali from AIpreneur. Uncover powerful tips and navigate the tax labyrinth like a pro. Stay tuned for real-life examples and detailed advice in our upcoming videos. Remember, knowledge is power, especially when it comes to taxes. Welcome to today's video, where we'll be diving deep into the world of tax strategies. If you are new to my channel, please subscribe to not miss any more video from me. Like and share my channel to your peeps. I'm Kali from AIpreneur channel, and I'm here to help you navigate the complex labyrinth of the tax code. Remember, everyone's tax situation is unique, so it's always a good idea to consult with a professional for personalized advice. Also remember, I am not a CPA or tax professional. This information from my personal research that I would like to share with you. For now, let's explore some general tips that could help reduce your tax bill. First up, let's talk about the traditional 401k. Contributing to a 401k not only helps you save for retirement, but it also allows you to reduce your taxable income by the amount you contribute. It's a win-win situation. You're saving for your future and reducing your current tax bill at the same time. The beauty of a 401k is that it's a form of forced savings. The money is automatically deducted from your paycheck before you even see it. Plus, many employers offer a match, which is essentially free money. Let's consider an example. Meet John, a 30-year-old software engineer earning $80,000 per year. His employer offers a traditional 401k plan and matches contributions up to 5% of his salary. John decides to contribute 10% of his salary to his 401k. That's $8,000 per year. Since these contributions are pre-tax, they reduce his taxable income. So instead of paying taxes on $80,000, he's now paying taxes on $72,000. Additionally, John's employer matches contributions up to 5% of his salary, which is $4,000. This is essentially free money added to John's 401k. So, by the end of the year, John has contributed $8,000 to his 401k, his employer has contributed an additional $4,000, and he's reduced his taxable income by $8,000. This is a simplified example, but it illustrates the benefits of contributing to a traditional 401k. Always consult with a financial advisor for personalized advice. Next, consider opening a health savings account, or HSA. An HSA allows you to contribute pre-tax dollars and use the money to pay for qualified medical expenses. It's a great way to set aside money for healthcare costs while also enjoying a tax benefit. Plus, unlike a flexible spending account, FSA, the money in your HSA rolls over year after year, so you don't have to worry about losing your savings if you don't use them all in one year. Let's consider an example. Meet Lisa, a 40-year-old marketing manager with a yearly salary of $70,000. Her employer offers a health savings account, HSA option with their health insurance plan. Lisa decides to contribute $3,500 to her HSA this year. This contribution is made with pre-tax dollars, meaning it reduces her taxable income for the year. So instead of paying taxes on $70,000, she'll be paying taxes on $66,500. Now, let's say Lisa has a medical emergency later in the year that results in $2,500 in medical expenses. She can use the money in her HSA to pay for these expenses. The great thing about an HSA is that withdrawals for qualified medical expenses are tax-free. So, Lisa effectively pays for her medical expenses with pre-tax dollars, saving her money on taxes. This is a simplified example, and actual tax savings will depend on various factors. Always consult with a tax professional for personalized advice. Investing in long-term capital gains can also be a smart tax strategy. If you hold on to your investments for more than a year, you'll pay a lower tax rate on any profits. So patience can indeed be a virtue when it comes to investing and taxes. This strategy encourages long-term investment rather than short-term speculation, which can be beneficial for both your financial health and the overall economy. If you're self-employed, setting up an S-corporation could potentially save you money on self-employment taxes. It's a bit more complex than some of the other strategies, but it could be worth exploring if you're in the right situation. An S-corporation allows you to pay yourself a reasonable salary, and then take the rest of your income as distributions, which aren't subject to self-employment taxes. Let's consider an example. Meet Alex, a self-employed graphic designer who earns $100,000 per year. As a self-employed individual, Alex is responsible for paying both the employer and employee portions of Social Security and Medicare taxes, which total to 15.3%. Alex decides to set up an S-corporation for his business. As the owner and employee of the S-corporation, Alex can now pay himself a reasonable salary. Let's say he decides on a salary of $60,000. This salary is subject to the 15.3% self-employment tax. The remaining $40,000 of Alex's earnings can be taken as distributions from the S-corporation, which are not subject to self-employment taxes. So, by setting up an S-corporation, Alex is able to save on self-employment taxes for the $40,000 in distributions. This can result in significant tax savings. This is a simplified example, and actual tax savings will depend on various factors. Always consult with a tax professional for personalized advice. Now, let's talk about state income tax workarounds. Some states have found ways to work around the SALT deduction cap. If you live in one of these states, you might be able to take advantage of these workarounds to reduce your tax bill. It's a bit of a gray area, but it's worth looking into if you live in a high-tax state. Let's consider an example. Meet Emily, a resident of New York, which is a state with high income taxes. Emily earns $200,000 per year and pays a significant amount in state income taxes. However, the federal SALT, state and local tax deduction, is capped at $10,000, which means Emily can't deduct the full amount of her state taxes on her federal tax return. To work around this, New York has implemented a program where Emily can make a charitable contribution to a state fund in lieu of paying state taxes. Emily decides to contribute $15,000 to this fund. She receives a state tax credit for 85% of her contribution, reducing her state tax bill by $12,750. On her federal tax return, Emily can now deduct the $15,000 charitable contribution, which is not subject to the $10,000 SALT cap. This effectively allows Emily to deduct more of her state taxes on her federal tax return, reducing her overall tax liability. This is a simplified example, and actual tax savings will depend on various factors. Always consult with a tax professional for personalized advice. Homeowners, listen up. There are several tax breaks available to you, such as the capital gains exclusion and the mortgage interest deduction. Owning a home can be expensive, but these tax breaks can help offset some of those costs. For example, the capital gains exclusion allows you to exclude up to $250,000, $500,000 if married filing jointly, of gain on the sale of your home as long as you've lived in it for at least 2 of the last 5 years. Finally, And perhaps most importantly, consider hiring a good CPA. The tax code is complex and constantly changing. A CPA can help you navigate these complexities and find the best tax strategies for your individual situation. They can also help you avoid costly mistakes and potentially save you thousands of dollars in taxes. That's it for today's video. I hope these tips help you understand some of the ways you can reduce your tax bill. Remember, always consult with a professional for advice tailored to your specific situation. Thanks for watching, and don't forget to like, comment, and subscribe for more financial tips and tricks. In our next video, we'll delve deeper into each of these strategies, providing real-life examples and more detailed advice. So stay tuned, and remember, knowledge is power, especially when it comes to taxes.